331 and a quarter. I want to welcome Chris Swift to the show. He's with Swift Trading Incorporated, based out of Nashville. So, Chris, from what I understand, the corn is also being countered on that bullish side from the ethanol angle, but also being countered by weather that has really been beneficial so far to most of the corn crop. They expect a pretty high planting number today.
They do, and I don't see any reason why they wouldn't. We noticed that the rains that came through Illinois and Ohio last night all be very beneficial to the crop already planted, and it looks like there's not much in behind all that, so I think we'll be able to get quite a bit more of the planting finished up, and looks like beans are going into the ground at a pretty hefty rate as well.
Well, that's absolutely right. Now, there is the scenario where there is too much of a good thing. Some areas are reporting flooding and washing some of that corn out. It may have to be replanted. However, that is a little different story than last year when the wet weather prevented the planting from occurring in the first place. And all the planting was delayed by a month or two. At least this time, most of it is getting in the ground, and it is not quite the same scenario. You mentioned the soybeans. Let's take a look there and see what they're doing here on the open. We have the July soybeans gaining 4 cents at 842.5, and November is 4.5 higher now at 850 so far this morning. What's the difference between the corn and soybeans? Why are soybeans rallying today?
I think the soybean oil is why. So you mentioned that the ethanol might get a little bit of an uptick because of the gasoline. Soybean oil, because of the biodiesel, may be some of the reason for it, because we're noticing that meal is a little bit lower this morning, but the oil is up pretty good. So probably a little bit of demand from the oil.
So July is 48 points higher right now at 27.06. If we check out the meal component of that soybean trifecta here, we have the July meal now down $1.80, and we're at $285.70 per ton. Moving on to our wheat, in Chicago wheat, we have had a little bit of a lower issue so far today. Let's take a look at this Chicago market here, where we have the July now 4.5 lower at 495 3/4. And we also have the Kansas City market so far today trading a little lower. We have the July down 4.5 at 447 3/4, well off its overnight high by about 7 or 8 cents. And Minneapolis wheat, so far this morning, we have the July contract down 3/4 at 505.5. I was reading this morning that the Black Sea region wheat exporters are going ahead and shipping anyway, even though they thought there would be tight supplies. And that is kind of keeping pressure here on the wheat market this morning. We'll come back and talk more with Chris Swift about our livestock trade on the other side of these messages. Come on back. Let's go back and check our livestock trade now that we're underway here for about a half an hour or 45 minutes. Let's look at live cattle first. And boy, oh boy, they are showing some strength on the nearby contracts today. We have the June futures now $2.45 higher at $99.45. And isn't it interesting that it went up and hit exactly $100 even, right on the nose for the high today, and then backed away from it a little bit. But it is $2.45 higher. The August up 117, now 115 higher at 98.97. The deferreds get gradually less to the upside as you go further out. On the feeder cattle trade, here we go with the May contract, $1.47 higher at 126.20. August gaining $1.60, quoted at 132.67. And on the lean hog market, we currently have June now 55 cents higher at 58.42. July gaining 35 cents. And here again, we have the far out deferreds for next fall up over $1. So the most strength in the deferred contracts there. Interesting development there. So let's go back to the cattle. What do you see here, Chris?
Well, it's quite interesting because in the front month, June, we know that the packer still needs significant inventory, and it's much easier to process those cattle right now at a 1,350 to 400-pound weight. You go through it, and that's what the grocery store really wants is that product, and we still leave the backlog of inventory in the back to have to deal with. And so I think that's why you're looking at June up just a little bit more than the rest of the months. There's still a pretty heavy demand for inventory that meets that specification for the packer.
You know, the cash market is making it hard for the futures to even catch up now.
Oh, it is. 110 and 115 trades last week, so but they're so sparse. That's an interesting why the futures didn't just limit up every day trying to catch it. Those trades are very sparse, and we are coming into a time frame where we're going to have some more inventory to have to market. And the trade guess for the on-feed report is still showing 94% on feed with a 73% placement and a 74% marketed number. That's a lot of inventory that has not been marketed or processed.
When you look at the hog chart, of course, we've been talking about how it made a correction here last week, but it is bouncing a little bit today. Do you think they have run their course in that?
Probably so. I do know that packing capacity has increased significantly in the hog market, and because that lean hog index, a portion of that is the cutout. The more product that you have, the more that product should go down, and that should start impacting the index a little bit. And I think that's why the futures are carrying discounts. Note, historically, we always carry a significant premium in the summer months to the index. This year, it's completely backwards. We've got a very negative basis in the hogs, and that's a very rare instance during the summer.
All right. Well, thank you, Chris, for all the explanations there. The Dow up 788 right now, John, so still continuing higher in that equity market.
Thank you very much, gentlemen.